Welcome back to FinWeek Money Matters. Cash is arguably one of the most critical components of your investment portfolio. Smart investors can make a lot of money if they have access to cash when sentiment is negative, but they need to weigh this up against a poor return when markets are booming. In this insert, we look at the role of cash in your investment portfolio. Joining us for this, Craig Gradidge, Director of Investments at Gradidge-Mahura Investments. Craig, thank you for joining us. So let's talk about cash right now, because by all accounts and purposes, if you holding purely cash, you're basically losing money because you're not beating inflation.
Yes, look, cash is what we consider a lazy asset. It doesn't work very hard. All your returns come from interest. And
interest that doesn't beat inflation.
Interest after tax doesn't beat inflation. So your entire return is subject to income tax. And after inflation, after tax, you're going backwards slowly on a real basis. So it's a very lazy asset in that it doesn't generate returns over the long term.
But what is the role of cash in a portfolio? I mean, what are your thoughts on that, Garth?
I look at this a little bit differently. I'm not looking at it from the point of view of you're a guy with a retirement fund and, do you allocate so much to a money market? Do you allocate so much to equity, so much to bonds? I'm looking at more from the point of view of the average guy at home who is saving for a retirement fund. He's probably in a balanced fund, etc. The money's coming off of his salary every month. And for me, there is nothing more amazing than seeing 6 months' salary in my bank account. And I just feel that having a pool of cash at your disposal in your bank account has so many benefits. I mean, for starters, you sleep better at night. Secondly, there's the transactional value of having that available. If there is an opportunity you see, be it a car that you can get at a cheap price and flog to someone else for twice the amount, you can access that if you have cash. Now, I'm using sort of glib examples, but the point I'm making is for the average person, I think there's immense benefit to have constant cash flow, and too many South Africans live from literally hand to mouth or paycheck to paycheck.
Are cash strapped?
They're cash strapped because their salary lands in the bank account, all the debit orders come off and they got nothing, and then they hit the credit card. And I'm not saying I have the answer as to how to build up the cash pool in your bank account, but I look at it from that perspective. I think what Craig's saying is absolutely true if you're managing a retirement portfolio, but if you look at it slightly differently, just having a pool of cash is of immense psychological benefit, if nothing else.
Yeah, I mean, I think there's an interesting quote from Warren Buffett. It says, rule number 1, don't lose money. Rule number 2, refer to rule number 1. And it's this idea that, cash in theory you're not going to get wiped out. You may have, and this is where the definition of losing money comes in. Are you losing money if it's sitting in your bank account and you're going backward, which is to Craig's point about it being, it's essentially a negative asset. But if you have that around when in 2008 or February 2008, you would have done really well to be able to pick really nice assets at a really good time. And I was looking for some research over this morning, and there's an article from Charles Schwab which basically says cash gives you flexibility, liquidity, and stability. And I think that we often
flexibility, liquidity, and stability.
So obviously you've got stability because you have access to the money, and exactly to God's point is that when you have a problem, you have cash to access. Liquidity is obviously everybody needs real cash. I mean, I think we've just lived through a credit crisis, which I think is the biggest issue facing us and still facing us for a while to come. And then finally, you've got the flexibility to decide what are you actually going to put some money into. And exactly to the point of 2008, lacquer, now we've got something we can, when choice assets come up, do you take that short-term view of saying, well, I'm losing money in the short term, but when markets reprice or when opportunity comes up, I can actually access it.
The issue is it takes discipline, because if you do have 6 months of cash in the balance sheet, that's of course salaries, it takes discipline just to use that for something useful and for something that builds on that money, as opposed to dipping into it to go on holiday or something like that.
Sure. I think the topic is right. It's the role of cash in your portfolio. So it's not to be seen as an investment asset class. It's to be seen as playing a particular role, and that role has been alluded to. It's the safety or the stability that it provides. It allows you to take opportunity of sharp fall off in risky assets. So when we structure portfolios, we do give our large clients with lump sum amounts and exposure to cash, because the rest of the portfolio is invested in risky assets.
What's your thinking around
that? Go down.
What's your thinking around that in terms of perhaps in this environment now, what percentage of a portfolio would you advise be in cash?
Yeah, so at the moment we are allocating a bit more to cash than we were a year ago.
Mm-hmm. And why is that?
Because risky assets have given you very good returns over the last year. So equity is up over north of 25%, property north of 35%, offshore has given you very good returns north of 20%. Bonds have even given you return north of 15%. So it's hard to commit capital in an environment where you've just come off a very strong market in all your risky assets. So as a result, you tend to have a bit more caution. But you're right, the clients' minds tend to short-circuit that behavior, and now they're committing to risky assets, and in 2008 we're committing to cash. If you look at unit trust inflow statistics. Mm-hmm. So cash is your money market assets are losing money. In fact, there's outflows, net outflows. In 2008, there were large inflows into cash, and it's exactly the opposite of what Mark said should be happening. It should be large outflows when things are tough and large inflows when things are going good.
Yeah, I think one of the things that I find fascinating is how do you actually put money into cash? Because it's very easy to just say, well, 10, 20, 30%, whatever is your cash. But, do you do as a straight just to set up a money market account? Do you take one of the money market offerings from the banks, for instance, or through a unit trust? Or, or do you actually not really care about the actual interest attached to it, but rather just find a savings vehicle, a 30-day call account? What are the best, most functional options in the current environment?
It depends on that role that it needs to play in your particular portfolio. So if it's transactional, probably a bank account or deposit or call account would suffice. If it's part of a bigger portfolio, investment portfolio, then perhaps a money market would give you a higher interest than a bank deposit. So it depends on your particular, the role that you need cash to play in your portfolio, whether you go to the bank or whether you go to some kind of unit trust money market.
And the role of hard currency cash, we always have this, I understand that there's, it's a big question to ask, but
Sure.
There's a lot of interest from South Africans to get their money abroad, either into equities or into what is broadly called hard currency. You can debate whether the dollar, for instance, is a hard currency.
Yeah.
But the idea of having that sort of nest egg that's sitting offshore, you believe that interest rates are low overseas, and hopefully you get money offshore now. You're able to get a step up when the interest rate increases start coming through.
Yeah, an investment into offshore cash is really a bet on the currency because you're going to get anywhere between naught and nothing as an interest on offshore cash. So, especially after costs.
Yep.
So, offshore cash at the moment is
pointless
for local investors, simply a bet against the currency.
Okay. If we take it down a peg, and I think a lot of people think of this in terms of unit trusts or retirement portfolios, just on a personal finance level, what do you see as the benefit of keeping a decent, healthy cash flow? Let's, for argument's sake, maybe 6 months' salary is a bit of a high bar, but let's call it 3 months' salary. Do you think there's merit in that? I do, for very personal reasons. I'm not saying it works for everyone, but you're someone who advises people every day. What do you think?
Yeah, look, what you described earlier is what we call contingency funding. So life happens, and you've got this emergency funding that you can tap into when life happens. So that's a very important role. Also, it's in terms of downside protection. The cash is wonderfully protective of capital, in that you don't lose money unless you invest in something where there's a scam or a sambo where perhaps things are not kosher. But it's a very safe asset, and also it's, how can I put it? It allows you to take advantage of opportunities that just suddenly appear. So it is definitely an asset class which has a role to play, but it's not an asset which is going to give you returns.
Yeah, sure.
Exactly. That's an important thing to understand.
It's almost like a value investor type of approach. When times are good, you start actually selling off and start having a little bit of cash to start dipping into stocks when value appears.
Yeah, it's the irony.
But that's of course if we're talking about from an investment perspective.
Sure. The irony of cash is that it gives you the best returns at the point when you should be putting your money into risky assets. So 2008, interest, you were getting double-digit returns on cash. and that was the time to be committing to risky assets. Now you're getting single-digit returns on cash, and perhaps you should be applying a bit more caution. So it has this funny characteristic in that when times are good, you're going to earn low returns, but the chances are, because the market's forward-looking, you may have missed out on the returns from risky assets.
Mm-hmm. Yeah, I mean, one of the things that's quite interesting, and I know it's not your that it's not necessarily area of speciality, but the idea around money markets, I mean, they've always been perceived as incredibly safe, and in principle a money market is safe. But we have seen some instances of money market funds actually blowing up. I mean, how do you go, what's the process of picking the right money market investment vehicle? I mean, what do you guys go through when you pick something for parking cash?
Yeah. Generally, you go for the funds that are AA or AAA rated. They're going to give you a low return, but you're not going to have a blowout. So that generally is a golden rule. AA rated should suffice. Where there have been blowouts, those funds didn't have any kind of.
In South Africa, how often? I mean, how many blowouts have we had that kind of thing happening here?
Yeah, there was one recently involved about 2 or 3 years ago, where I think it led to a suicide and a whole lot of stuff being revealed. I forget the details. But there was deliberate
it was African Dawn. With African Dawn, I think it was one of the microlenders had a small cap market link account, and they were promising way above what. I mean, the easiest way to go and do it is go and look at the newspapers where they give you what your expected return is, whether it's Capitec or any of the big four, and then you go and compare it. And if it's 2 or 3 percentage points above it, it's quite a significant number there.
Too good to be true.
Too good to be true.
Yeah.
Yeah. Let's talk about the downsides, because we talked about inflation and everything, but what do you see as the downsides of having too much cash on hand?
Well, exactly what Craig said, it's lazy. So you've got to decide why you want to have that cash lying around in the first place. In my case, I like having cash because I sleep better at night. I feel that if there is an opportunity out there that I can access, and not necessarily, I mean, I'm an average guy, not necessarily an opportunity on the stock market, but maybe you find something you can buy and sell and make a few grand on the side. From that point of view, I like having money available to me. I like the liquidity. And another side of the coin is, I don't see the point. What is the point of deploying your cash into a market that, at least to me, looks hell of expensive? Bonds have run hard, the equity markets run hard. I don't understand why I would want to put the cash that I have available into that. I like having a pool of liquidity available to me. I'm not by any stretch of the imagination saying all my retirement money is in cash. No, it's not. But I like just having a pool of cash in my bank account. And if anyone out there thinks I'm talking absolute nonsense, and for certain people I probably am talking nonsense, go to YouTube and plug in Mark Cuban, Cash is King. And if you don't know who Mark Cuban is, find out. He's an American billionaire. If you're an entrepreneur, he's someone you should know about, and just listen to what he says. He's got tons of money, and the last time I checked, had more than 50% of his assets in cash.
Okay,
and I think there's a reason for that.